Hello, everybody. It's Ed Yardeni. It's September 3rd. That's what it is here in Long Island. And joining us today is Eric. And Jackie Dougherty has been with us for 9 years. And I thought it was, we're way overdue to have you on these video calls. Jackie's been doing amazing work for us on disruptive technologies, updating our stories on China. Doing a lot on the quarterly earnings reports, putting together some of the themes that are popping up in those reports. I do want to start out with Jackie. Jackie, you have to put on your audio, so we can all hear you. Just on my end, if there's any barking, it's because all three of my four dogs are in the room here. Max is always reliably here, and he's at my feet snoring today, so you're not going to see him back there. But I don't know if you can see Cooper. Cooper is right there by the pillow, but she kind of matches the couch. I'm going to have to get a white couch so the dogs stand out a little bit more, but she's having a little snooze. And one of the things that the three of us all have in common, aside from Yardeni research, is we all have dogs. So we're all dog people, and they are, I think they're among our best friends, though we have other friends, I'm happy to say. Well, with that, Jackie wrote some really good, again, she does some really outstanding work on keeping us posted on disruptive technologies. It's been one of our themes for years that economists generally don't pay enough attention to technology and how it solves problems and boosts productivity and creates disruptive shocks to the economy that more often than not are positive rather than negative. Occasionally, we can have a negative shock, like we did with the tech wreck of 2000. Jackie, you've been doing some work of late on artificial intelligence, on autonomous driving, and now on Thursday you did a story for us on robots. Is this still kind of pie in the sky down the road? You know, we've been writing about quantum computing, we've been writing about nuclear reactors, and they all seem to be, you know, further and further down the road. What can you tell us about robots?
No, I think robots, well, mechanical robots are already in factories, but what's sort of the latest and greatest are the humanoid robots, robots that look, move, talk even like humans. And, you know, they could be here, you know, if Tesla and Elon Musk are on target, he could be using humanoid robots, many of them in his factories next year, and have them for sale for others by 2026.
So it's like the movie Poltergeist. They're here.
Exactly. They've arrived.
Are we talking about like by the end of next year or 2 years from now? When is Elon Musk going to be using them in his factories?
Well, presumably he's using them to help him manufacture Tesla cars. And that's sort of his, you know, the thing that he might have that makes him win in this game over others is he's got this expertise in-house for both artificial intelligence in the autonomous driving that he's produced, as well as in manufacturing cars that maybe some of these AI companies don't have. He's already got manufacturing plants up and going, and that should help out.
Well, there's a lot of similarities between the software used to create autonomous driving, and even without autonomous driving, there's a lot of software in his cars. And now these humanoid robots have a lot of software. And then to combine them with artificial intelligence requires just a vast amount of data that you feed them on what they can expect in the workplace. And correct me if I'm wrong, but Elon seems to have an advantage there as well.
He does, but he does have competition. I mean, there's a company called Figure AI. They're a lot smaller than Tesla is, obviously, but they're using the OpenAI software. And, you know, in a video that we've posted online, what this robot can do is amazing. It can answer questions from humans. It can pick out the object on a tray that's edible, and then explain why it picked out that object. So, you know, if these videos are accurate, the future is really going to be fantastic.
And what about the Chinese? The Chinese just had a, a convention of humanoid robots, or at least
Yeah.
a convention to show off what their skills are. How many companies were there? Like we're talking about hundreds or tens or twenties or.
Oh no, there are hundreds of robot manufacturers in China, and they're definitely in the race. It
Mhm.
just based on videos that are online, it looks like, Figure AI and Tesla still have an edge, but
Right.
it's not a huge edge.
Right. I think Elon's talked about universal basic income. That's one of the questions that always comes up on these things is what are we going to do with all these humans that are replaced by humanoids? And I guess Trump said, well, we could all be poets or writers or make movies, do whatever we want, and there'll be some sort of universal basic income. Obviously, we've seen some aspects of that among progressive politicians who like the idea just in principle. But I guess we'll see how this all develops in terms of its impact on society. And Elon's been really very concerned about the potential for artificial intelligence generally and humanoids to be dangerous to humans. So from what I understand, he's tried to program these things so they, they won't come in and not only take our livelihoods but also kind of attack us.
So you'd hope, right?
Yeah, you would hope. Jackie, anything else you want to add on that particular story? You'll be updating it on a regular basis. Right now, it looks like the first test will be in a Tesla factory, but once these things get manufactured, the goal of these manufacturers is to pump out thousands of these things on a regular basis.
Yeah, no, then the next thing will be the Optimus update is supposedly happening by year end. And then we'll see how many Tesla's actually able to produce to get into its own factories.
Yeah.
And then it'll be what does this do to Tesla margins and productivity for Tesla? And how much of an edge does it give it over other companies? Or how quickly will other companies try to do the same thing?
Well, Elon Musk has always been very successful when his stock price goes down, of getting all excited about all the other things that Tesla can do besides make cars. Because if it's just a car company, presumably it's not all that exciting. But uh, clearly, there's a lot of other technologies. Again, I mentioned in our last call that I'm listening to the Elon Musk Audible biography. It was written by Walter Isaacson, and it really is a must read. I mean, he just keeps getting more involved in bringing the future to a reality, and so it's really worthwhile reading all that. Eric, why is the market down this morning? And what did you think of those manufacturing PMIs that came out? Is that the market was already down before 10 o'clock, before the PMIs came out, the
Yeah.
MPMI. So it was already kind of, I guess, discounting that it's September, and September is a spookier month than October for the stock market.
Yeah, it's always a fun question. Why is the market currently doing whatever it's doing? Yeah, I mean, we kind of rallied into the close on Friday. You had month end, people going away for the holiday. Yeah, I mean, September is bad seasonals. Maybe people are projecting that, or they're just back at their desks after a vacation. Within the ISM report, we did see a rebound in employment, which was like unduly weak in July and really didn't match up with some of the regional Fed surveys. But I mean, more of the same. The
Well, it
ISM
was it was
manufacturing.
a small rebound, and then it was a small rebound in a sector that doesn't hire a lot of people in the first place. So yeah,
Mhm.
you're right. Last month when that came out, everybody was shocked by how weak the PMI was, and when you looked at it, it was the employment indicator. And now I guess the shock is that what has it been a couple of years now where it's been below 50. So I
Yeah.
guess people are still coming to any positive spin you can put on the goods. We've been looking for some signs of a that the growth recession, the rolling recession in goods is coming to an end. After we went on a buying binge there for a couple of years, and so it was natural that spending by consumers would take a dive, but it didn't
Yeah.
take a dive, right? What has been happening to
No, I
consumers?
mean, it just kind of moderated around an all-time high while services consumption has grown. But I mean, I think, as rates come down, they're going to come down. There's a little bit of a lag, I suppose, until that financing activity picks up. Mortgage rates are down like 75 basis points, and everyone's freaking out that mortgage activity hasn't just like jumped up immediately. It takes a little time. Refinancings are up. Buying a home is something that leads to furnishing your home, buying a car, stuff like that. So I think as rates come down, over the next quarter or two, we'll start to see, the
Mhm.
good sector show signs of life.
Jackie, if you don't mind, just don't turn off your video because we want to see you, but turn off your audio because I think we're getting some feedback having all three of us on, and then I'll just signal you when we get some Q&A discussion going on. Let's look at some charts here, and we apologize. Some of it is sort of repetitious. We've been telling the same story for a while, and that's okay because it's been working pretty well for us. But the idea is that recessions are caused by the tightening of monetary policy that in the past caused a credit crisis, a credit crunch, and a recession. That's for us. That's the Seinfeld yada yada yada. We've been telling that story for a couple of years now, and it's been working well because we've been pointing out that we're not having a crisis this time, so we're not having a credit crunch, so we're not having a recession. Also, recessions can be exacerbated or maybe even caused by surges in oil prices, and so far that hasn't been happening either. And that's because the global economy is relatively weak. Jackie's written about China, and China still looks awfully weak, actually. Europe is barely growing, so that's keeping commodity prices down. So far we haven't had a recession, but there is this widespread perception that in the past, once the Fed has started lowering interest rates, it's like, wow, look at how quickly they plunge. And so Eric and I are thinking that one of the reasons that the market is expecting so many rate cuts over the next 12 months is because it's happened before. Once the Fed starts lowering interest rates, it has to lower them dramatically. But I think, again, what that analysis misses is this credit crunch theory of ours. Not really a theory, it's just it's an observation. It's an empirical reality that you have to factor in what we call the credit crisis cycle, that when monetary policy tightens in the past, has caused these crises, which then led to a recession, which then forced the Fed to lower interest rates dramatically. This time around, we've had that mini banking crisis that did not turn into a credit crunch or a recession so far. And as a result, we think that the expectations for these multiple cuts in interest rates are overdone. We do think, like everybody else does, that there'll be a cut in September. We're still in the one and done camp, thinking that notwithstanding today's PMI, that a lot of the indicators for August are going to turn out to be really pretty good, because some of the weakness was in July was weather related. And if that's the case, then it might be one and done in September for this year. But as Eric indicated, we're not saying that there couldn't be any more cuts next year. And right now, we've been talking about it, thinking maybe 2 to 4 next year, not 6 to 8 or whatever people are talking about in that kind of realm. And besides, the other thing is we necessarily have to have a hedge clause and say a lot's really going to depend on the elections. If it's a sweep by either the Democrats or Republicans, we have to consider that could have some inflationary consequences, and that might actually hold the Fed off from lowering interest rates, certainly as much as the market thinks. Then again, if we have gridlock, that would potentially be a whole different story. But let's skip a few of these charts because some of them you've seen before and we discussed in the morning briefing. This is just a chart showing that there's no credit crunch. Year-over-year percent change in total loans, excluding in all loans, is still up on a year-over-year basis. It's the C&I loans that have been weak, and that's consistent with the goods recession, growth recession, where inventories have not been growing much at all, and so there isn't a need for financing with C&I loans. Another sign that there's no credit crunch is there was a little spike at the beginning of August in the VIX, a little spike in the high yield spread with the 10-year Treasury, but that looks pretty calm now as well. Eric, you want to take us a little bit through where are we going here? We'll go to the Atlanta Fed data.
Yeah, I mean, this probably gets revised a tad lower after today's manufacturing PMI, but no, the GDP now for Q3 looks pretty good. Real final sales and even real final sales to private domestic purchasers, which is not only a mouthful, but it's kind of what Powell looks at as underlying demand or the underlying trend of growth, look pretty good. So, I mean, there's a lot of bears out there who think GDP is going to get revised lower and somehow we're in a recession or, one is looming ahead. But no, I mean, this continues to point to continued growth about trend for what we've seen historically. Kind of lines up with our whole normalization thesis.
And we started to hint at this research that you're doing last week, and then you've already done it, and we're editing it, and it goes out tomorrow. Tell us about this GDI versus GDP controversy. From what I understand, the gross domestic income has been very weak, while the gross domestic product has been surprisingly strong. And the naysayers, the pessimists, I guess, remember Vice President, maybe you don't remember, but Vice President Spiro Agnew once called them the negative nabobs of the nabobs of negativity, the nattering nabobs of negativity. And so there's a lot of people saying that the GDP number is overstated. What's your take on that? Which should we be looking at, the GDP or the GDI?
Yeah, so I mean, technically they're two measures of the same thing, economic output or activity. GDP, as we all know, like is the main thing that we all look at. GDI tends to get more airtime when there's a big discrepancy, and there is a very big discrepancy between the two right now. In the second quarter, real GDP growth was 3% at an annual rate, seasonally adjusted, and GDI was 1.3%. So a lot of hardlanders saying GDI is much weaker, GDP is going to be revised lower. In the past, that's happened, but it's not like a given. For instance, in Q4 of 2022, GDI was negative 3%. And then we had two more quarters of sub 0.5% growth. So like that's much worse than 1.3%. Ostensibly, the recession would have started then. It obviously hasn't. I think what the BEA and a number of officials say is just average the two, and you'll probably get a good sense of where they'll line up over time, because over time they do equal each other. So that get us to 2 point something% GDP growth, which sounds fine. I don't really think. So I think there's actually, I'll keep it brief. I think there's a reason that GDI has been structurally weaker post-pandemic, and that's because of the way it calculates interest income. All the interest expense that the Treasury pays, all the interest that the Fed pays on reserve balances and reverse repos, it says that's like a negative. It's an interest payment. In reality, it's a huge source of interest income for consumers, for corporations, for households. So all that interest expense wasn't really a thing in the past. The Fed didn't have $3-something trillion of reserves that it was paying 5.25% on, or 5.4% on. And that's a new norm for the economy that people looking at GDI now just aren't factoring in.
Yeah, so when we look at the data, we're happy with it because really since the middle of 2022, we started talking about immaculate disinflation, the idea that inflation could come down without a recession. And that was not a widely held view, but certainly through the second quarter upward revision in real GDP, through the GDP deflator inflation rate, which we have here through the second quarter, you can see that we have in fact had a tremendous amount of disinflation, and we've had that without a recession. And real GDP was revised up significantly in the third quarter, and the Atlanta Fed's data suggests that so far, so good, and that real GDP is increasing again in the third quarter. And by the way, that's based on July data, which again, we think was weather related. So if we're right, third quarter should be another quarter of immaculate disinflation, which has been good for the bond market and good for the stock market. And good for all of us. Um, and more data here on the on July, which again gets us into the third quarter, confirming the economy is still growing. Eric and I were just talking about personal consumption expenditures of goods, total, non-durable, and durable goods. And this is the durable goods. And you can see it had that big spike when we all got freed up from the lockdowns. We went on a buying binge. We couldn't buy services, so we bought goods. So it spiked to an all-time record high. And now I think what's amazing is that, well, we both think is amazing, is that it didn't like spike up and then come back down. It just kind of stayed at this record high level. The government was providing lots of checks and people had liquidity. There's excess savings. Presumably they've run out of that. But meanwhile, the labor market's creating jobs and real wages are going up. So our thesis here is that, and if you draw an upward trend here, we're kind of catching up with that upward trend line. And this thing, which has been, it actually really hasn't been that flat. It's actually been going up on a short-term trend basis. So it all looks pretty healthy to us. Now, of course, one of the reasons consumer spending has been doing well is because net worth has been flying to record highs. And so there is an inverse relationship between net worth divided by disposable personal income to the savings rate. And that relationship is especially strong when you look at owners' equity in household real estate. How much do people actually have in equity in their homes relative to DPI? And clearly, as people feel like they've got more equity in their homes, they feel they can cut back on their savings rate. Now, before we all freak out and say, oh my God, people are making some pretty bold assumptions here about asset values, it's going to be a speculative bubble. Let's not forget, as we have been talking about for the past couple of years, we also have the impact of the retiring baby boomers. They don't have any income earned income to save out of, and they are dissaving, and that means that again, consumption can continue to grow as long as employment grows, which we think it will, as long as real wages grow, which we think it will, and then that's boosted by a drop in the savings rate. Eric will have some things has written some things for Monday and also for Tuesday, for today, and for tomorrow. We'll have more to say on the capital spending, but we think capital spending is less interest rate sensitive. One example being that the software. This is intellectual property, which includes the software, all-time record high, and that's in 2017 dollars. You can see the actual amount of spending on software in 2017 dollars, all-time record high, and a lot of that is rented. So when you rent all this capital software, which is included in capital spending, rising interest rates don't really have that much of an impact on people's willingness to continue to rent software. I think that covers quite a bit of ground that we wanted to cover. But there's a lot of analysis of the latest GDP numbers, which you can look at in today's morning briefing. So why don't we? Oh, yeah, I did want to point out this chart, which goes back to the consumer. This shows that I know that this is a politically charged issue. The extent to which people have suffered as a result of inflation. And everybody knows that prices are on average about 20% higher today for consumers than they were before the pandemic. And it's become very politically charged. But I think it is important to realize that the reality is real wages, especially for lower income workers. And when I say lower income workers, I'm talking about 80% of payrolls. That's production and non-supervisory workers. This is their wage, average hourly earnings divided by the consumption deflator. This is all wages for everybody, and this is for higher wage workers. And you can see that they actually have not performed well relative to inflation, and are only slowly starting to come back to where they had been just at the peak right after the pandemic, whereas the 80% of the workers are doing somewhat better. Again, that's the macroeconomic data, but as an economist, I am sensitive to the notion that economists look at inflation on a year-over-year percent change basis and say, oh, look, it's come down pretty dramatically. We look at it even on a 3-month basis, and oh, look, the PCED is up only 1.7%. So what are people so upset about? Well, what they're upset about is a lot of things are in fact more expensive, and people who don't have high incomes or whose wages haven't kept up with inflation clearly are suffering, and they're right to complain. So that takes us there. Let me open it up to Jackie. You can put on your audio again, and Eric, you want to field the questions for us?
Yeah. Yo, stop barking. My dog loves early mornings. Okay, first one from our friend Michael Brush. Can you please comment on why or why not high credit card balances may be a problem?
Well, it is a problem. It's a problem for people who have those kind of balances. And I think we have seen that consumer credit's at an all-time record high. We are seeing delinquencies going higher, but from our vantage point, looking at the data, they've gone higher. They've kind of normalized it, gone back to kind of where they are typically in an economic expansion. And the reality is, we haven't seen any historical example where heavily indebted consumers caused a recession. However, if something does cause a recession, heavily indebted consumers clearly will exacerbate that. So we are aware of this issue and would agree that if something causes a recession, this will make it worse. But when we talk about the consumer, as we've pointed out numerous times, you can't really generalize. You got, let's say, 75 million baby boomers that are increasingly retiring, and they have quite a bit of net worth, all-time record high of 78 trillion. So it's a lot of different experiences out there. And from a market perspective and how it all adds up, is it still adds up in our mind to an economy that's growing, a consumer that's spending. But you're right to raise this as something to be aware of and to be concerned about. Eric,
sorry about that. I was muting.
Okay.
Next one from Gus is Ed. If we get a 50 basis point cut in September, do we have risk of negatively influencing the carry trade?
That's been sort of our take, right, Eric? You want to comment on that? You're the carry trade in-house expert, so we'll let you carry that.
Tough title. Yeah, no, I mean, it could, especially if that shocks relative to expectations. For one, I don't think the Fed would shock the market unless something breaks somehow, or there's some like new unknown development. That said, a lot of the quant funds and algos have the August volatility now baked into their VAR calculations, their value at risk. So they're going to have less extreme leverage, and the chances of like this unwind coming out of nowhere just are weakened. So like, yes, it would definitely impact the carry trade, but no, I don't think that's like the source of the next breakage.
And to just briefly describe the carry trade mechanics, 25 is baked in the market, 50 would be a shocker, though by then it wouldn't be a shocker because presumably the economic indicators would have not gone our way. They would have been much weaker than we expected. And so suddenly we get a 50 basis point cut. Mm-hmm. That would weaken the dollar, that would strengthen the yen, and again, create problems for carry traders. But as you said, we've already had a dress rehearsal for that shock. And once you'd imagine that portfolios would be prepared for that. Go ahead, Eric, next.
The next one is from Cagdis. Ed, I got the impression from your latest quick takes that you're struggling to see seasonal September correction to come into the stock market. Is that because we already saw a mini correction in early August?
No, I mean, what's done is done. I mean, clearly that mini correction in August was that carry trade, largely because of the carry trade, partly because of the employment report being weaker than expected. And no, I'm just, I jinxed it, right? So I'm not going to blame Eric for this one. I came up with the idea that it's hard to come up with anything that's really bearish for September other than September is usually bearish, or more often than not has been bearish. It isn't always bearish. Maybe it'll get out of its system this morning. Eric, some of it was, we had a good Friday, and so people decided maybe to take some cash out today because it is September after all. But I think that the issue for us in September is we're expecting better than expected indicators for July, and on the employment side, retail side, personal income side, and if that's the case, we could see the bond yield going up back to 4%. Though today it's going the other way. Might be, if we're right, then today's a good day to short the bonds. But with regards to the stock market, we've been through carry trade black swans. We've been through geopolitical risks rising, still remain high. And yet the stock market has held up remarkably well. Earnings are doing just fine. So the only problem with the piece that I basically wrote on September's coming, what could possibly go wrong? And the answer I came up with is I can't come up with too much that could go wrong. And, even if the data is really strong, the market should say we'll take that. Better economic growth with a reduced chance of multiple cuts in interest rates might be something the market could learn to live with. It's been living with it since the beginning of this year when people were looking for multiple rate cuts. We were only looking for 2 to 3, and even that turned out to be wrong. There have been no rate cuts so far. Okay, go on, Eric.
Yeah, we can probably finish up with this one.
Yeah.
This is from Chip. Jackie, if you could peer into the crystal ball, when do you foresee China's growth getting back on trend? It's a brutal question.
Lucky you.
That's a tough one. That's a tough one, especially with the recent manufacturing numbers out on Friday. They were less than expected. The government really has to do something to stimulate consumer spending. And until they do that, it's hard to see the country turning things around.
Yeah, it seems to us that they've got a structural problem with their real estate market. If you look at their real estate stock price index, it keeps going down, and that continues to take down the rest of the stock market. That has a big negative wealth effect on consumers, and but the combination of falling home prices and falling stock prices is really depressing consumers. And the government really, I don't know that there's much they can actually do, because they also have the demographic issue, which is weighing on consumers over there. So they're just opting out for more manufacturing, more exports, and that's creating deflation around the world and exacerbating trade tensions, which may very well be a significant issue next year, depending on how the politics shape up. Jackie, thanks for joining us. We'll have you back for sure. Eric, we'll have you back for sure. Ed, oh, that's me. Nice to be back. Anyways, thank you all for joining us. We hope you enjoyed this presentation, and we look forward to meeting with you again next week. Thank you.
Thanks, everyone.
Bye.